Every single business decision, from buying a coffee machine for the office to acquiring a billion-dollar company, starts with one thing: a transaction. And if that transaction gets recorded wrong, the entire financial picture of a business falls apart. Today, we're going to fix that. Welcome back. In this video, you're going to learn exactly how businesses analyze and record financial transactions. We'll cover the accounting equation, debits and credits, journal entries, ledger accounts, and the trial balance. By the end of this video, you'll understand the complete journey of a single transaction, from the moment it happens all the way to the financial report. Let's get into it. Section 1. The accounting equation, the foundation of everything. Before we can record anything, we need to understand the rule that governs all of accounting. It's called the accounting equation, and it looks like this: assets equal liabilities plus equity. Assets are everything a business owns: cash, equipment, inventory, buildings. Liabilities are everything the business owes: loans, unpaid bills, credit balances. And equity is what's left for the owners after all debts are paid. Think of it like this: if you own a house worth $300,000, but you still owe $200,000 on the mortgage, your equity is $100,000. Same logic applies to businesses. Here's the key insight: this equation must always stay balanced. Every single transaction affects at least two parts of this equation, and the balance never breaks. Ever. That's not an accident. It's the entire design of double-entry accounting, which has been used for over 500 years. So now the question is, how exactly does a transaction affect this equation? That's where debits and credits come in, and this is where most people get confused. Stay with me. Section 2. Debits and credits. Not what you think. Here's where things get interesting. Most people assume debit means money going out, and credit means money coming in. That's actually wrong, and that misunderstanding causes major confusion. Let's clear this up right now. In accounting, every account has two sides: a left side called debit and a right side called credit. Whether a debit increases or decreases an account depends entirely on what type of account we're talking about. For asset accounts, debits increase the balance and credits decrease it. For liability and equity accounts, it's the opposite. Credits increase the balance and debits decrease it. A helpful way to remember this is with the phrase DED, KLIC. Debits increase expenses, assets, and dividends. Credits increase liabilities, income, and capital. Let's walk through a quick example. A business receives $5,000 in cash from a customer for services. Cash is an asset, so we debit cash to increase it by $5,000. Revenue is an income account, so we credit revenue by $5,000. Both sides move. The equation stays balanced. Simple, right? But here's something that trips people up. What happens when a business buys something on credit, meaning they promise to pay later? How does that get recorded? Let's find out. Section 3. Journal entries, where recording begins. The journal is the very first place a transaction gets officially recorded. Think of it like a diary for the business. Every financial event gets written down here in chronological order. A journal entry always includes the date, the accounts affected, the amounts debited and credited, and a brief description called a memo. The debit account is always listed first and written flush to the left. The credit account is listed second and indented slightly to the right. Let's try one together. A company buys office supplies worth $200 on credit. Office supplies is an asset. It goes up, so we debit office supplies for $200. Accounts payable is a liability. The company now owes money, so it goes up, meaning we credit accounts payable for $200. Total debits equal total credits. The equation stays balanced. Now here's something worth thinking about. A business might have hundreds or even thousands of transactions every single month. Writing each one in the journal is just the first step. But how does anyone make sense of all those entries later? That's exactly what the ledger is designed for. Section 4. The ledger, organizing the chaos. Once a transaction is recorded in the journal, the information gets transferred into something called the general ledger. This process is called posting. The ledger takes all those individual journal entries and sorts them by account, so you can see at a glance exactly what's happening with cash or inventory, or any other specific account. Each account in the ledger is represented by what's called a T account, named after the shape it makes on paper. The left side shows debits, the right side shows credits, and the balance is the difference between the two sides. For example, if cash has 3 debit entries totaling $10,000 and 2 credit entries totaling $4,000, the balance is $6,000. That's your running total for that account at any point in time. Ledger accounts give managers and accountants a clear picture of individual accounts without having to dig through every journal entry. It's organized, it's efficient, and it's essential. But here's the thing. Even with a perfectly organized ledger, how do you know the entire system is still in balance? That's where the trial balance comes in, and it's more powerful than most people realize. Section 5. The trial balance, the moment of truth. The trial balance is a report that lists every account and its balance at a specific point in time. The purpose is simple. Add up all the debits, add up all the credits, and check that they're equal. If they match, the books are in balance. If they don't, something went wrong somewhere. Think of it like a final check before a big exam. You've done all the work, journalizing, posting, organizing, and the trial balance is where you verify that everything adds up. It's the last checkpoint before financial statements are prepared. Now here's an important nuance. A balanced trial balance doesn't mean there are no errors. You could record a transaction in the wrong account, and the totals would still match. Errors like that require a deeper review. But a trial balance that doesn't balance? That's a guaranteed sign something is wrong, and it needs to be fixed before moving forward. The trial balance is really the bridge between your day-to-day recording work and the financial statements that tell the full story of a business's health, income statement, balance sheet, and more. And that's the complete journey, from the accounting equation through debits and credits, into journal entries, organized in the ledger, and confirmed with the trial balance. Every transaction, no matter how big or small, follows this exact path. If this video helped you understand how financial transactions actually work, do me a quick favor. Hit the like button right now. It genuinely helps more students find this content. And if you want more videos breaking down financial accounting concepts in plain language, subscribe and turn on notifications so you never miss one. Drop a comment below with any concept from this chapter that still feels unclear. I read every single comment, and I might just make your question the topic of the next video. See you in the next one.